The biggest IPO of the past 2 years is just around the corner. Last week, British chipmaker Arm, spelled ARM, kicked off its roadshow and revealed it will go public at a target valuation of $52 billion. For context, other companies of that size include Chipotle, Lululemon, and Dell. Arm specializes in smartphone processor designs. Its clients include Apple, Google, Nvidia, and Samsung, and each of those companies have agreed to buy shares at the IPO. Its largest shareholder, though, is Softbank, the Japanese investment firm run by Masayoshi Son. We'll get to Softbank's involvement in this deal in a moment, but Scott, first, you predicted that the IPO market would pick back up in the second half of this year. It looks like you were right. We've seen a slight pickup in IPOs recently. We had 15 in July and 11 in August. Do you have any initial thoughts on Arm as a company or on this IPO and what it might do to the IPO market?
So, there's two things here. The first thing is indisputable. It's a great business. They power, I think, their chips power 99% of the world's smartphones. 70% of the world's population uses an ARM-based product. Their chips aren't just in smartphones, they're in other things: smart speakers, TVs, surveillance cameras, thermostats. The average U.S. household, get this, Ed, has 22 connected devices in 2022, and that's up from 11 devices in 2019. Quick math, that means it's doubled in about 4 years. And ARM just dominates the smartphone CPU market. And they also see growth in cloud computing. They do licensing agreement, receive royalty payments for chips, which have incredible margins. Licensing is 37% of the revenue, royalty is 63% of the revenue. Their growth was flat last year, which will hurt the valuation because of a slump in smartphone shipments, and net income declined. And it's a weird time to go public in the sense that they posted a 20% net income margin on $2.7 billion in revenue in 2023. That was down from 27% net income margins in 2021. Chip designs have incredible, it's a typical technology company that's very IP driven, and that is they're incredibly expensive to develop, and then they have monstrous margins, right? To launch a software product costs millions, if not hundreds of millions to develop, but then you have 90 plus points of gross margin. Their research costs were 42% of revenue last year, but their gross profit margin was 96%, and their operating income margin was 25%. About a quarter of the revenue comes from China, and again, we talked about the risks there. And this also comes down to valuation, and that is, there has never been a drunken sailor like Softbank. And in terms of just throwing cash at the wall at crazy valuations, and they're supposedly targeting an IPO price range of 47 to about $51 a share, which would give it 18 times its trailing 12-month revenue. And Nvidia trades at 37, but I would argue Nvidia's radically overvalued. So what will be interesting is if SoftBank gets their money back or makes money, because at some point it was a bad investment. And so what will be interesting is on the first trade, if SoftBank actually is in the red or the black here.
Yeah, so we'll get to SoftBank in a moment. But you mentioned the valuation. Arm has 18 times price to trailing 12-month sales multiple. And then you mentioned Nvidia, which is at 37. But then you compare to other chip makers, Intel's at 3x, Qualcomm's at 3x, AMD's at 8x. So Arm's on the higher end here, and I agree, Nvidia is probably way overvalued right now, riding off of this AI boom. But Arm's still high. Do you think that a $50 billion valuation is too ambitious compared to those other chip makers, which are seeing like 3 and 7 and 8x multiples?
I do, because, what's the story? It's not growing. Maybe it'll start growing again. I guess the dominance in the smartphone market, I don't know what maybe the moats here, but it's hard to see, again, at the valuation that banks are talking about, SoftBank is going to have to take, I think, like a 30% haircut, and that is the expected valuation on the day of the IPO is below what SoftBank paid for it. But SoftBank needs to get some cash back. It wants to take the product out. I would bet the bankers said, look, there's demand for kind of blue chip, big, iconic brands like this. And at some point, alternative investment companies, they're not meant to be holders. They once they get to 3,
But
5, 7 years,
just
they want
sorry
out.
before because I didn't mention SoftBank's role in this in the intro, so I should just clarify that. The context here is that SoftBank, which is the Japanese investment firm we've talked about a lot on this show, largely because of how poorly they perform, they own around 90% of the company. And last month, they valued the company at $64 billion, which is around 30% higher than the expected valuation at the IPO. So I just wanted to provide that context. But yeah, you were talking about that mismatch in valuation, the fact that they're going to go into the public markets 30% lower. What are your thoughts on that?
Well, it sucks to be a grown-up. They got to get money back to their investors. They have to fund stuff. They're not meant to be, they're in the moving business, not in the storage business. And that is they need to move shares at some point out and recognize valuation for them. And the market has just changed dramatically. In addition, there have been, I would argue Masayoshi Son is the worst investor in history. He got incredibly lucky on his stake in Alibaba. And let's be honest, that was luck. And then everyone assumed, he must be a genius. And he began to prove that he's a terrible investor over and over and over again. And that the people who invested in Softbank, it's just, show me a company that just makes no fucking sense, but raised money at $1 billion valuation. And there's a 1 in 2 chance it was funded by Softbank. It just, this craziness infected all aspects of the organization. So I doubt they'll get their money back. It feels like, at least not for a while, a great company, an outstanding company. Tesla's an outstanding company. NVIDIA is an outstanding company, and they're dramatically overvalued, as is or was this firm when SoftBank invested.
So just the history of SoftBank's involvement in Arm. They acquired Arm back in 2016. They acquired it for $32 billion. And then they immediately sold 25% of that stake to their own vision fund, which is SoftBank's tech-focused venture fund, basically. And just a side note, when they made that trade, Masa Son told analysts, you can say, quote, you can say almost with confidence that it will grow 5x in 5 years. That obviously didn't happen. But something strange is that last month, SoftBank bought back that stake from its own vision fund unit. And that's where we saw this $64 billion valuation. My question to you, have you seen that before? Why would SoftBank be transferring its stake in a company between different units and essentially buying it back from the vision fund? What's the point in that?
There might be something administrative here around tax treatment or a change in strategy, and one asset makes more sense than the other. What it also might be is a purposeful head fake to the markets. And that is they want to send a signal that smart people value this company at $64 billion. The last 2 rounds of WeWork were nothing, in my opinion, but jazz hands to say, oh no, this company is worth 35 or 40 billion because smart people are investing capital at this valuation. And you dumb shit retail investor should value it at 55 because here's the momentum. So it's a bit of a head fake. And I think that's probably what happened here is it wants to send a signal to the market. It wants to send a mark. In addition, they might be out raising money. And when you're raising money, the potential investors want to look at your returns, and your returns are based on marks. And you get to mark your assets at the most recent valuation. So isn't it fun? I'm on the board right now of a company, and we just closed a round. And I said, this is ridiculous that we're trying to raise at this valuation. Let's raise at a more sane valuation, even if it's a down round, and go raise more money because the company needs capital, and I think things are going to get worse. And what was clear is that the previous investor, who was the largest shareholder, would rather raise less money and would rather participate himself at a higher valuation so he can mark his book and his stake at a higher valuation, even if that valuation doesn't make any fucking sense. So he can then try and fly to Riyadh and say, I'm up 22%, not 11%, and you should invest more money. So you really have to look. These related party transactions are fake marks. Yep. The only marks you can trust are marks where a round is led by fresh capital, that is new capital into the company. And they can get it wrong, but at least they think that is what the company is worth and that they're going to get a return on that investment.
This is exactly the question I wanted to ask, which is like, is Vision Fund going to now go to their LPs and say, oh, look at our rate of return. We made good money on our investments, when in reality, they just bought it. They sold it to themselves, which is completely fake. Should there be regulation around that, or does it not matter? Because at the end of the day, the investors are going to get their money back. I mean, the Kingdom of Saudi Arabia, who invested all of this money in the Vision Fund, yeah, they are going to get something back because they did sell that stake at a 64 billion valuation, however irrational that may be.
Yeah, I would imagine the Vision Fund is going to have a slightly more difficult time raising money than Bernie Madoff at this point. I just don't. I think an easy way to get fired would be to explain why you put capital into the Vision Fund in 2023.
Yep.
And I think what they've said is, let's take a horrible situation and try and make it just awful. Sell this thing, give us our money, good riddance, and we're gonna invest elsewhere. I can't imagine, but I've seen stranger things. People continue to invest in ARK, Kathy Wood's fund, despite every piece of evidence that they are terrible investors or not very good investors. So stranger things have happened, but what I found when I have had any sort of interaction, their primary investors are out of the Gulf. And something I admire and respect about the sovereign wealth funds and the investors in the Gulf is that they hire the best people regardless of where they're from. And they're smart. I've actually been in some of these meetings.
But they're also SoftBank's biggest backers, right?
100%. But what I would say is that a decent definition of smart is that you learn. And you're going to make, it doesn't matter how smart you are, you're going to make mistakes. They fucked up. They trusted Masayoshi Son. They bought into this crazy vision. And you can see how it would happen. He took whatever it was, $50 million and turned it into $20 billion at Alibaba. Mm-hmm. And he's likable and charismatic, although when I read his investment deck, it felt like a 16-year-old on shrooms before a business plan competition. It was just so weird. It'd have a picture of a hummingbird, and then it would say, and then a microchip, and it would say, love. Like, what? Anyway, good for him. But they're not going to, I'd be shocked. When I've been in meetings with these sovereigns or these funds in the Gulf, they have the best and brightest people poring over your numbers and asking really thoughtful, good questions. So I think SoftBank at this point is just about trying to get people, their pennies, their dimes, their hopefully 25 cents on the dollar back. This was, you want to talk about giving someone $100 billion to go play in traffic. This thing just made absolutely no sense.